Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio and cut right through all the market weakness. I'm your lead analyst. Today, we are putting TD SYNNEX, ticker SNX, on the anvil. Now listen, they just dropped a blockbuster quarter that absolutely blew past every single expectation on the street, and the stock took off. But you know us here at Iron Financial, we don't chase the headlines. We look past that shiny, polished surface to inspect the real structural integrity of the foundation. So is this company actually forging durable, long-lasting profits, or is this whole thing just a cleverly disguised value trap? We are about to find out. And that's where I come in. I'm your market skeptic, and it's my job to stress test these numbers and see if they bend. Today, we're putting SNX through a complete diagnostic. We're going to start with that Q1 blowout everyone's talking about. Then we're going to inspect whether it's a real profit machine or just blowing smoke. We'll check the foundation for any cracks, see how they're actually rewarding their shareholders, and then we'll look at the road ahead. And finally, we will deliver the Iron Financial verdict. Let's get to work. Okay, let's get right into it. The bull case for SNX right now isn't just strong, it is white hot. I mean, the first quarter results they just posted were nothing short of a statement piece. This wasn't just a beat on expectations. This was a complete and total demolition of expectations. The market, it was pricing in a decent quarter, maybe a solid one. What they got was an absolute grand slam. This is the kind of performance that forces everyone to reevaluate what they think they know about a company, and you can bet the bulls are charging hard on this one. Now, what's really telling when you look at this slide is the language being used. The CEO, Patrick Zammit, he's not just taking a victory lap for a good quarter. He's framing this as powerful, continuing momentum, record non-GAAP gross billings, and record non-GAAP diluted earnings per share. And let me tell you, those are not just hollow buzzwords. This quote is the opening shot. It's the declaration that the company's strategy isn't just working, it's firing on all cylinders and setting brand new benchmarks. This really sets the tone for the entire bull thesis. Absolute, undeniable, in-your-face strength. And here is the first pillar of that strength, an 18.1% jump in revenue year over year. Now, for a company of this scale, and we're talking about a company that does over $17 billion of business in a single quarter, that kind of growth is absolutely massive. This is not some small incremental gain, it's a serious acceleration. It tells you that the demand for what they do as a key technology distributor is incredibly robust. They're grabbing more market share, they're executing at an extremely high level. This is the real heavy lifting of top-line growth, and frankly, it's impressive. But hang on, because the revenue number, as strong as it is, doesn't even tell the whole story. You have to look at this, 24.4% growth in non-GAAP gross billings. So what is that? Well, gross billings, it represents the total value of everything they sold, and it's often a much better sort of leading indicator of the underlying business activity than just revenue alone. So what this is telling us is that the core business engine is running even hotter than that headline revenue figure suggests. More products, more services, more transactions are just pouring through their system. This is pure, unadulterated business velocity. And here it is. This is the knockout punch. This is the number that literally made jaws drop all over Wall Street. Their non-GAAP earnings per share didn't just beat analyst estimates, it absolutely crushed them by 43%. Let me just repeat that so it sinks in, 43%. When a company beats earnings by a few pennies, it's a good day. When they beat by a country mile like this, it signals a fundamental miscalculation by the entire market. It shows that SNX isn't just growing, they are forging incredible tangible profits from that growth. And they're doing it far more efficiently than anyone, and I mean anyone, predicted. So let's just lay it all out on the table here. I mean, the crucial point is laid bare in these numbers. Just look at these year-over-year changes. Revenue is up over 18%. Okay, strong. Gross profit, which is the raw profit from their actual operations, is up over 26%. That right there shows you they're expanding their margins at the gross level. They're making more money on every single dollar of sales. But the real story, the one that truly matters, is down at the bottom line. GAAP EPS, the official accounting number, more than doubled, up 104%. And their preferred metric, the one they talk about, non-GAAP EPS, is up almost 69%. I mean, there is simply no way to look at this slide and see anything other than a company that is in a period of extreme, powerful acceleration. The evidence, it just seems undeniable. All right, hold on. Undeniable is a very strong word. I'll grant you, the headline numbers, they look like they were forged in a blast furnace. They are big, they are shiny, and they've definitely got the market all excited. But here at Iron Financial, we know that sometimes the brightest fire can hide the deepest cracks. So it's time to take off the sunglasses and put on the safety goggles. Let's turn this thing over and inspect the welds because it's time for the skeptic's inspection. And this right here is the question that every single serious investor needs to be asking themselves right now. We heard the CEO's quote, we saw the record numbers, and that term, non-GAAP, was front and center in all of them. On the surface, this company looks like a bulletproof financial fortress. But non-GAAP is a company's custom-built version of its own reality. Look, it's not a lie, but it's not the whole truth either. So the real question is, what actual costs are being adjusted away to make those profits look so darn good? What are they choosing to conveniently exclude from the picture? Before we go any further, let's just be crystal clear on what we're talking about here. Non-GAAP earnings, sometimes they call it adjusted earnings, is basically an alternate set of books. Management takes the official, legally required GAAP numbers, and then they just start subtracting expenses that they feel aren't part of the core business. You know, things like amortization of intangibles from acquisitions they made years ago, or the cost of paying their own employees with stock. They argue it gives you a cleaner view of their ongoing operations. And you know what? Sometimes it does. But it can also be used to paint a much rosier picture by just ignoring very real, very tangible business costs. Our job is to see just how much paint they're using. And hey, you don't have to take my word for it. Their own guidance illustrates the point perfectly. This isn't our table, this comes straight from their earnings release. Just look at the GAAP. The official GAAP net income is projected to be between $166 and $206 million. But the non-GAAP number they want you to focus on is almost 40% higher at $243 to $283 million. So how do they bridge that huge gap? Well, they add back $75 million for amortization and another $25 million for share-based compensation. That's $100 million in costs they're asking you to just ignore. Share-based comp is real expense. It's how they pay their people. And amortization is the accounting cost of assets they bought in the past, a real cost of doing business. So is the profit machine really as powerful as it seems, or is it just getting a significant boost from some, let's say, creative accounting? That's a fair challenge. That gap between GAAP and non-GAAP is significant, and it's absolutely something investors need to understand. But let's zoom out for a second. A single quarter, even a blockbuster one like this, does not make a sound investment thesis. The real question is about the long-term structural integrity of the business itself. Is this recent strength actually built on a solid foundation, or is it just a pretty facade on a shaky structure? This is the core debate we need to have. Is this explosive growth actually translating into sustainable, long-term profitability? And here it is. Here is the first major stress fracture I see in the foundation. This slide right here, this is the heart of the entire bear case. Over the last 5 years, TD SYNNEX has grown its revenue at a blistering 25.6% compound annual growth rate. I mean, that is world-class growth by any measure. But look at the other side of the ledger. Over that very same period, earnings per share, the actual profit that belongs to each share of stock, has only grown at a meager 4.3% per year. I want you to think about that. They are doing a phenomenal job of getting bigger, but they are doing a terrible job of getting more profitable for their shareholders on a per-share basis. This is a massive, glaring disconnect. I see that disconnect, but I think you're looking at the wrong part of the engine. Look, EPS can be affected by a lot of things that happen below the operating line. Things like taxes, interest payments, weird one-time items. So let's look at the core business instead. This chart shows gross profit over the last 5 years. It is a steady, undeniable climb from about $3.6 billion to nearly $4.4 billion. What this tells me is that the fundamental engine of the business, buying products from manufacturers and selling them to resellers at a profit, is fundamentally sound and is consistently generating more raw profit dollars year after year after year. The foundation is solid, the core operation is strong. More gross profit dollars are good, but it is not enough. A company this size, this mature, should be demonstrating what we call operating leverage. That just means as your revenue and your gross profit grow, a larger and larger percentage of that profit should fall to the bottom line, because your fixed costs are being spread over a bigger base. But the data shows that TD SYNNEX's operating margins have been flat for 5 years. They are getting bigger, but they are not getting more efficient. Every new dollar of gross profit costs them just as much to generate as the last one did. That is not the sign of a well-oiled machine. That's a sign of a machine that's just adding more fuel to go faster without actually improving the engine's efficiency. And that, to me, is another crack in the foundation. Okay, the margin debate is absolutely critical, and it's a point that the bears will continue to hammer on, for sure. But while we debate efficiency, You have to look at what management is actually doing. They aren't just sitting on their hands. They have built something else, a powerful, consistent machine for returning capital directly to their shareholders. So regardless of what the margins are doing quarter to quarter, this company has a very clear and aggressive framework for taking the cash it generates and putting it right back into investors' pockets. And this is a major, major pillar of the bull case. And the total picture it paints is really compelling. Right now, we are looking at a total shareholder yield of over 5%. That is a powerful, tangible return in any market environment. It's broken into two main parts. First, you have a solid 1.2% dividend yield, which is the cold, hard cash they pay you every quarter just for holding the stock. But the much bigger piece of this pie is the 3.93% buyback yield. This means the company is aggressively using its cash to buy back its own shares, which reduces the total number of shares out there and makes every remaining share that you own more valuable. Combined, this is a very strong commitment to shareholders. And this isn't some new development either. Let's just look at the dividend history. This timeline shows a beautiful, consistent staircase of growth. It went from 20 cents a quarter back in 2021 to 48 cents today. That is more than double in just 6 years. This isn't a company that's just paying some token dividend to check a box. This is a company with a clear, stated policy of raising its payout consistently. This is management signaling its extreme confidence in the future cash flows of the business. You simply do not commit to a rising dividend like this unless you believe the foundation is strong enough to support it for years and years to come. And this number right here really illustrates the sheer scale of that commitment. In the last fiscal year alone, they returned nearly $750 million to their shareholders through that combination of dividends and buybacks. So the crucial point is this. While analysts like us can sit here and debate margins and growth rates all day long, this is real cash hitting shareholder accounts and reducing the share count. It's a powerful support beam right under the stock price and a core reason to own the company. That capital return program is impressive. I will definitely give you that. It is a strong support beam. But even the strongest beam can fail if the load on top of it becomes too great. And that incredible Q1 performance has now set a very, very high bar. The market has priced in excellence. So the question we have to ask now is, was that a one-time surge, or is this a new sustainable level of performance? It's time to gauge the momentum and look at what the company itself is telling us about the road ahead. So this is their guidance for the second quarter. From a bull's perspective, the midpoint of this revenue guidance at $16.5 billion is still about 4% above what analysts were expecting before this report. So that's a strong signal. The non-GAAP EPS midpoint of $4 is also very healthy. But, and this is the skeptic's but, just look at the numbers compared to the quarter they just reported. Revenue in Q1 was $17.16 billion. The guidance is lower. Non-GAAP gross billings in Q1 were $25.78 billion. The guidance is lower. And that non-GAAP EPS was a whopping $4.73. The guidance is significantly lower. So while it's still a strong forecast that beats the old expectations, it is also a clear and undeniable deceleration from the blockbuster quarter they just posted. The momentum is already slowing down. And that brings us to the final, crucial question. We have examined the blockbuster quarter, we have stress-tested the foundation, and we have looked at the cracks. We've seen the powerful shareholder returns and the signs of a potential slowdown on the horizon. So now it is time to put it all together. It's time for the iron financial verdict. Is TD SYNNEX a well-forged opportunity, or is it a value trap just waiting to spring? Let's summarize the bull case. It is built on a framework of pure steel. You have a record-shattering Q1 that demonstrated explosive growth in both revenue and, more importantly, in earnings. You have forward guidance that, despite slowing down a bit, still comfortably beats the consensus estimates out there. You have an undeniably powerful and consistent capital return program that puts cash directly in shareholders' pockets and supports the stock price. The core engine, when you measure it by gross profit, shows steady, reliable growth. And all of this is built on their dominant position as a critical middleman in the global technology supply chain. It's a powerful combination of performance and position. But every suit of armor has its weak points. And here are the cracks in the case for SNX. First, there is a heavy, almost total reliance on those non-GAAP metrics to tell that strong profitability. The official GAAP numbers paint a much less rosy picture. Second, and this is the big one for me, you have that major 5-year disconnect between explosive revenue growth and anemic EPS growth. That is a structural problem. Third, the flat operating margins are a huge red flag, suggesting they are not gaining efficiency as they scale up. And finally, their own guidance, while strong, clearly points to a slowdown from the peak performance we just saw. These are not minor issues. These are fundamental questions about the quality and the sustainability of this company's performance. So here is our final verdict. TD SYNNEX is a fascinating and really complex case. The Q1 performance was, without a doubt, incredible, and that shareholder return program provides a very solid floor under the stock. It's a powerful support beam. However, you simply cannot ignore the fundamental flaw in the profit-forging process. The long-term failure to translate that massive revenue growth into meaningful per-share profit growth is a serious, serious concern. It suggests that while the engine is running at high RPMs, there's a problem somewhere in the transmission. So our final question for you to ponder is this. Is SNYX a high-performance engine that is using its powerful shareholder returns to mask that fundamental flaw? For now, it's working, but investors must watch those operating margins and that GAAP versus non-GAAP gap like a hawk, because if that capital return spigot ever slows down, those cracks in the foundation could suddenly become a very big problem. That's our take. Now it's up to you to decide if it belongs in your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.